Today let's see how to prepare a bank reconciliation statement, and we are going to start with the cash book balance as I have written here. And in the cash book balance also we are taking up the case where favorable balance as per the cash book is given, right? Favorable balance is the debit balance, right? So here I'll put debit balance. Now, when we are taking up this case, the things that you should remember here is all the items of difference which have led to a decreased cash book balance are added to the cash book balance. So, all the items which have led to a decrease in the cash book balance are going to be added to the cash book balance, right? So, here you see these two things which have led to a decrease that should be added, right? Second one is items of difference which have led to a increased cash book balance should be deducted from the cash book balance. So these points you should remember when you are doing this case, that is where you start from the favorable balance as per the cash book. These are the two important things that you should remember. So based on this, you have to analyze all the transactions, whether that particular transaction has led to a increase or decrease in the cash book balance. That's what you have to see. If it has led to a decreased cash book balance, then add it. If it has led to an increased cash book balance, then subtract that, right? So now let's see what are the items that are to be added to the cash book balance, right? Now, first of all, checks issued but not presented for payment. This means we are issuing a check to someone. So, as soon as we issue the check to someone, we deduct that amount, we enter that amount into our cash book. That means the cash book balance gets reduced because you are issuing a check, right? But it is not presented for payment means the party to whom you have given that check has not presented it for payment yet, right? So till the time he has not presented it for payment, the cash book balance is less and the bank balance is more, because the money will go from the bank only when it is presented for payment by the other party, right? Okay. So next one is the checks deposited by a debtor directly into the bank. Whenever a debtor deposits a check directly into the bank, in that case again the bank balance goes up because the check has been deposited directly there, it will be credited. But we do not know when the debtor deposited that check, and in the cash book we can make an entry only when we get the information about it. So till the time we do not get any information about the debtor depositing a check directly into the bank, the cash book balance will be less, right? Any dividend collected by the bank, that increases the bank balance, but the cash book balance is still less because the information has not yet been received, let's say, and the entry can be made only after receipt of information from the bank that they have collected the dividend, right? Same way, interest allowed by the bank. Interest allowed by the bank means interest given by the bank. When the bank gives any interest on our deposits, it immediately credits that money, so the bank balance gets increased. But we can add that amount in our cash book only when we know that the interest has been given and how much interest has been given. So till that time the cash book balance is less, right? Bills of exchange realized or cash directly deposited into the bank but not recorded in the cash book. Whenever the bank collects any bills of exchange directly, or any cash has been directly deposited into the bank but not recorded in the cash book, in both these cases the cash balance will be less, again because when the bank collects a bill of exchange, the customer doesn't have any information on when the bill of exchange is collected till he receives some intimation, right? So he can't make that entry in the cash book. So the bank balance will be more and the cash book balance will be less. Whereas in this case, if you directly deposit any cash into the bank, but it is not recorded in the cash book, means the cash book balance will be obviously less, right? Wrong credit granted by the bank. When the bank credits some amount wrongly, that increases the bank balance, right? Obviously, that wrong credit will not be put in the cash book, so that decreases the cash book balance. Check deposited but not recorded. You have deposited a check into a bank, so the bank will collect the check, the bank balance goes up, but it has not been recorded in the cash book. You have forgotten to record it in the cash book. So obviously the cash book balance is less than the passbook balance. So these are the items which normally we get in the questions, which basically decreases the cash book balance, right? Other items can also be there. So you have to analyze the effect of those items as to whether those items are increasing or decreasing the cash book balance. So the thing that has to be remembered here is whatever items that lead to a decrease in the cash book balance should be added to the cash book balance, right? Now, these are the items that should be deducted from the cash book balance. Checks deposited but not collected. Checks deposited but not collected means the checks have been deposited. When you deposit a check, you add it to the cash book because you know that money is going to be, you have received the check, right? So you deposit the check, that means you will add it in the cash book. But the bank will not credit that amount unless that money is collected, right? Unless that check has been collected. So till the time the check is collected by the bank, the cash book balance is more than the passbook balance, right? Checks or bills of exchange dishonored. Whenever a check or a bill of exchange is dishonored, the bank immediately debits that amount. But the customer doesn't know when the bill of exchange got dishonored or when the check got dishonored, right? So he doesn't have any information, means he will not record it in the cash book. So the cash book balance is more, right? The next one, bank charges charged by the bank. Whenever the bank uh, charges any charges from the customer, it debits that amount, right? Okay, because that is a charge which it is taking from the customer for different services offered by the bank, right? So the customer doesn't know exactly how much bank charges the bank charged or when the bank debited those bank charges. So unless and until he knows that, he cannot put that in the cash book. So till that time the cash book balance is more than the passbook balance, right? Interest charged. When the bank charges some interest from the customer, it debits that amount. So the bank balance comes down, right? But the customer doesn't know how much interest was charged from him unless and until he gets some intimation from the bank or he gets a copy of his passbook, right? So till that time the cash book balance will be more because the customer has not deducted that money from the cash book, right? Then direct payment by the bank as per the standing order. Example, electricity bill, telephone bills, insurance payments. So whenever we give standing order to the bank that every month or every 2 months or whenever insurance payments becomes due, it should be made directly by the bank. The bank will make the direct payment and immediately debit that amount. So the bank balance comes down. But the bank will inform us that we have done this payment. So when the bank informs that we have done this payment or when we get a copy of the passbook, then only we can enter it in the cash book. So till that time the cash book balance is more, right? Wrong debit by the bank. In the earlier case we saw wrong credit by the bank. Wrong credit by the bank is to be added. Wrong debit by the bank means it decreases the passbook balance, whereas the cash book balance is more. So this is to be deducted, right? Then the last one, checks recorded but not deposited. Checks recorded but not deposited means You receive a check, right? And immediately you record that check in your cash book, right? So that increases the cash book balance, right? Because you have received a check, you're supposed to deposit that check in the bank, but you don't deposit that check in the bank. You forget to deposit that check in the bank, right? So already the cash book balance has increased because you have already recorded that amount. But the bank balance will increase only when you deposit that into the bank, and the bank will collect the amount, right? If you do not deposit that, then obviously that amount will never be collected by the bank and the bank balance will never increase, right? So here again in this case the cash book balance is more as compared to the passbook balance, right? So these are the entries which we normally take up. These are the entries in which we have to deduct from the cash book balance. So I have shown you the entries which have to be added to the cash book balance and which have to be deducted from the cash book balance in order to arrive at the passbook balance. Now I'll just show you one format of this bank reconciliation statement, right? How to make a bank reconciliation statement. We'll write like this. This is your bank reconciliation statement, and here we'll write as on whatever date you want to prepare it on. Let's say 30th June 2013, let's say, right? And then the bank reconciliation statement, this is the particulars column, right? And then you will have one column which is amount. I'll put here, this is particulars, right? And this one is amount, and here you'll have the details, and finally you have the amount column here, right? Okay, so first of all, let's say if I'm going to start balance as per the cash book, we'll write, right? And that will come in the amount column. Let's say the amount is 12,000. I'm just assuming this amount, right? Now after this you will put all the add items, right? Okay, so let's say something like this: checks issued but not presented, right? Now supposing this amount is, let's say, 1000, right? And then that will come in the details column, right? Okay. Now let's say interest allowed by the bank, right? So that is again, let's say 100 rupees. So supposing I have only these two items, right? So I'll add this is 1100 like this, right? And this 1100 will be added here, fine. So that is 12,000 plus 1100, that becomes 13,100, right? And now you will put the items that is to be deducted. So let's say bank charges 200. Okay, fine. I'm just assuming these amounts, right? Checks deposited but not collected, right? 5,000 rupees, right? And let's say something like wrong debit given by the bank. This is also to be deducted. So let's say the bank wrongly debited this much. So the total comes to 6,200 here. Now this 6,200 should be deducted from here. So whatever you get, that is basically the balance as per the passbook, right? So this is how we prepare the bank reconciliation statement. There is another another format of preparing the bank reconciliation statement in which we show the plus items and minus items. That format is basically like this: whatever is to be added will come on the plus items, and whatever is to be subtracted will come on the minus items, right? So there you have it like this: particulars, and then you have a plus items column and minus items columns, right? So here I'll write particulars, plus items and minus items. So this format can also be followed. The result will be the same whether you follow this or that, right? So bank reconciliation statement, again you will write as on the date, whatever date you want to prepare this on, right? And here you'll write balance as per cash book, right? Now this will come, the balance as per cash book, right? This is a favorable one, it will come here 12,000, and then you will start writing the items. Like here I had written checks issued but not presented, right? So here I'll write checks issued but not presented, and that amount whatever it is, it will come in the plus items. Like I had written something like this, bank charges 200 rupees or whatever is the amount, that will come in the minus items. So this is how uh, this is another way of preparing the bank reconciliation statement, the plus items minus items format. And the one which is followed normally, or it depends, I mean, like there's nothing like this is the there's nothing like you have to follow this or that, whatever is convenient that can be followed, right? Okay, so this is one way of doing it and this is the other way of doing it, right? So in my next session I'll take up a small example on this case and we will do that, right? So with that I end this session. Bye.